Just 2 weeks ago, DeepSeek had the investor community wondering if the big four cloud providers here in the United States would pull back meaningfully on their CapEx, as DeepSeek potentially proved that maybe you don't have to spend tens or hundreds of billions of dollars on data centers, and these models could be made more and more cheaply. We got over here on Equity Empire, both in the video and written form, and said that was absolute nonsense. And this week, we got the CapEx numbers finalized from the big four cloud providers. And not only are the big four cloud providers committing to spend more and more money in 2025, but it's also proving to you that the AI trend is absolutely intact. We got confirmation on the Google conference call, as much so as well. We'll talk about what this means to Nvidia as we start to look out into these quarters where a lot of these orders are going to come in. We'll look at Nvidia and judge on the price trajectory that could happen for the world's biggest chip maker. We'll also look at ARM Holdings. They reported earnings this week. We'll also look at Qualcomm. They benefit a little bit sometimes on the edges of the AI race. Are these semiconductor companies worthy of going in your portfolio? And then we'll look at a handful of stocks from a technical perspective as well. How have things held up over the past couple of weeks? As obviously we've had lots of volatility. What is going on, investors? Hopefully guys are doing well out there. I say it every week, but it was another big week in the semiconductor business with Nvidia. Not a lot of news out of them personally, but shares rebounded as investors started to realize a lot of the DeepSeek panic was just that. It was just panic. Shares were up over 13% to rebound into the $130 range with Nvidia. This thing was like down at $117 just a week or so ago. 52-week high still remains at 153. We'll look at it technically here in a moment. You do need to gut back up, retest, and break through that area for the uptrend to be intact. I don't think anyone truly believes the highs are in with Nvidia. That is because we got CapEx numbers from the major customers over at Nvidia. Amazon spending what they say is $100 billion on CapEx in 2025. That is up from the previous year where Amazon spent about $83 billion. Now, the difference with Amazon's number as opposed to the other three cloud providers is Amazon does have a little bit of warehouse in that spend. Couldn't tell you off the top of my head what it would be. If I were to guess, it's probably in the 5 to maybe as high as 15% range could be warehouse spending of that $100 billion. Last year, Amazon spent about $83 billion. So another meaningful bump for Amazon in the upcoming quarter. We also heard from Google this week as well. Shares of Google tumbled a little bit as Google pledged to spend $75 billion on data centers this year. Last year, Google spent closer to $52.5 billion. I think Wall Street was expecting a number closer to $60 billion. So that puts some shares under pressure. Primarily, what's amazing is I know nobody watching this video is confused about how the cloud business works, but you'd be surprised. If you go out in the finance community, Twitter, I know the IQ of the average Twitter user is pretty low, but you'd be surprised. I saw, quote, finance gurus. I saw people with newsletters. I saw people with influence within the finance community talking about how this is ridiculous. Companies like Amazon and Google and Microsoft spending $75, $80, $100 billion. They're just burning through all their cash flow, and these are no longer cash flow generating companies. What these people don't seem to understand is that these companies have to invest. It's very much like a property owner, folks. If you were trying to build up a property empire, what would you have to do quarter after quarter after quarter? You'd have to go out and buy more and more property, whether it's an apartment unit or a complex or a bunch of single family homes. You'd have to continue to go out and buy more and more and more of that. When you're a cloud provider, you have to buy more and more capacity. And interestingly enough, what we are finding from these cloud providers, and people don't seem to understand that, is that demand is actually exceeding their available capacity. And so if you were running a business where demand was so high that you weren't able to meet that demand, well, chances are you would probably continue to reinvest in that business. And that is exactly what Google is doing. Now, unlike Microsoft, which gave basically, I think, a quarter or two forward where they'll finally be able to meet demand, because Microsoft is in the same boat as Google, where demand is kind of outstripping their ability to deliver on that demand, at least in the cloud perspective. Microsoft gave us like maybe they're 2 quarters out from being able to fulfill that demand and it all being all good. Google didn't really give us any clarity there. They're just saying that demand exceeds their available capacity. Google also has obviously their own internal uses. So they're using their cloud to function for their search engine, for functioning of YouTube and those types of things. Very similar to Amazon as well, as they're building out this CapEx. Some of it is for Amazon.com, but the vast majority of this is rented out to other people in the form of AWS. Meta, we heard from the previous week, they're going to spend $60 to $65 billion on CapEx in the upcoming year. Last year, they spent $37 billion. Meta is different than the other three here. Meta doesn't lease out its excess CapEx. So when you see Meta spending $60 to $65 billion, some people might think, well, Meta must be behind or whatever. I also saw commentary, some people saying, well, Tesla is only spending this much on CapEx. They're way behind these four companies. Understand, with Meta and particularly Tesla as well, they're not leasing this out to other people, so they don't have to spend as much. Also, interestingly to note here, we're getting really into the nuance of these types of things. This is why you tune into a show like this. Google is going to build out their data centers using Broadcom GPUs. Broadcom GPUs do not carry the 75% gross margins that Nvidia. So when you buy an Nvidia GPU, you are paying a 75% gross margin, which means 75% of every dollar is actually just profit for Nvidia. On top of that, if you have Supermicro or Dell Computer or HP or one of these other server makers make those servers for you, they're tacking on another probably 10 points of margin. And then obviously you have server administrators at all these companies that have to be paid as well. So when you look at the spend across this, particularly at Microsoft, where they're going to spend $80 billion in 2025, dollar for dollar, Google's $75 billion will actually likely go further. That is because Google is going to spend the vast majority of their dollars, at least when we're talking about infrastructure and the chips themselves, they're going to be spending them on Broadcom chips, which don't carry a 75% gross margin. It's great for Nvidia, as these companies have committed big numbers, and all of these companies will spend with Nvidia, and Nvidia will do quite nicely. We'll talk about that more here in a second. But just understand, when you see these numbers, it's not an absolute game. You have to understand that Meta is not leasing out their excess capacity. So their $60 to $65 billion is particularly impressive because they are only using that for internal purposes. For Meta, Microsoft, and Amazon in particular, they are using Nvidia chips in the case of Microsoft almost exclusively. And so this $80 billion won't go as far as potentially Google's, and then maybe even Amazon, which have some custom silicon, which don't carry the gross margins that the others do. So very interesting. DeepSeek did nothing to change the environment. In fact, I think it only accelerated the need for more and more compute, because I think the overarching thing that investors are just starting to grasp, this is what's amazing. I know you guys watching this already grasp this. What the exciting thing is, investors are still just starting to grasp that AI applications are being used by very, very, very few people in the world. And so as AI continues to make its way onto the desk of computers in classrooms, gets to make its way into other applications that already exist, like airline booking and all the different things that we do on our daily lives, as AI makes more and more headroads there, well, it just means that more and more compute is going to be required to run those AI applications, because what we see here is primarily spent on training and getting these large language models up to a level that is suitable for a commercial environment. But at some point, we are just going to be running these applications all the time on our phones, on the internet, and those types of things, potentially through robots as well. And that is going to mean we're going to need more and more of this, because the last thing you want to do if you're Google is leave demand on the table. When they tell you this, it means that revenues in the cloud division, including profits, could have actually been higher if Google had the capacity to deliver. So that's exciting for Google. It's exciting for the companies in the cloud division. It is also exciting for Nvidia. As we move out into the back half of this year, my thesis for Nvidia, as we probably have, and this is just a thesis, that's a fancy term for a guess or a hypothesis, I guess, if I want to sound professional. I think you've got one more pump to the upside with Nvidia. How much higher than 153? I think you get into the area of law of large numbers where you're already at a $3.18 trillion valuation. You can't double this from here. Just these numbers and these revenues, they just don't support a $6 trillion valuation. They probably don't even support a $5 trillion valuation over at Nvidia. So can you get into 3.5 again, $4 trillion valuation? I think these numbers could support it in the right market. It all depends on where Nvidia comes at the back half of this year, because what we saw as it relates to CapEx spend, there was some front running of it, particularly with Amazon. They actually spent quite a bit in the most recent quarter, and it looks like maybe it'll be a little flatter, at least in terms of pace of spend for this $100 billion. I think they spent $27 billion in the fourth quarter. You look at Google and Microsoft, these companies will accelerate their spend as we get into the spring and summertime and early fall time, and certainly the winter time here in the United States. Now, this assumes all things being equal, no recession, no global conflicts, no whatever. I mean, pandemic, whatever we've been through as investors over the past 5 years, global financial crisis, all those types of things, interest rates, all those things could play into this. But everything being equal, if we sit here today with a similar economy as we do 8 months from now, well, Nvidia has a chance to come over and above the estimates that are already set out from Wall Street, because this company has had a year to prep Taiwan Semiconductor, to prep the other suppliers of this demand. And so everybody is working very hard to get Nvidia to $50 billion worth of revenue towards the back half of the year. I actually think, just based not just on my own brain, but using other people's brains and other people's logic, there's actually a chance that Nvidia could get closer to 60, 70, $80 billion of revenue for a single quarter if the company is able to do that at 70% gross margins. And depending on how they spin it to Wall Street, if they can spin, that Nvidia is capable of putting up $70 billion of quarterly revenue for any length of time, even if it's only 3 or 4 quarters, then yes, you do have one final push in Nvidia shares until you likely start to reach the limit of the valuation. You also start to reach the limit of what these companies can conceivably spend in a year on AI applications, at least in the current environment. All of these things are very good for the semiconductor business. All of this will flow down initially into the equipment makers. If you're in the ASMLs and the other equipment makers, CLS, I've had a lot of people say that they just crushed it on that trade. That's fantastic. All of those guys are going to run in advance. And I want to make the emphasis here, guys, with the equipment makers. The outside example, or the outside, could be ASML. If you want to buy and hold ASML for a while, you can go ahead and do that. But with the rest of these equipment makers, you have to sell them, because this demand is going to front run. This demand is going to look like it's going to go on forever, but it's not. At some point, this chart is going to crash and burn. And I'm going to get a million people in my comments being like, you recommended CLS and it went up and then it went down. And that is what I'm telling you is going to happen. This stock is going to go up and it's going to go back down. A great example is this company called Air Test Systems. So these guys made semiconductor stuff that went into electric vehicles. And so as electric vehicles received kind of their pump in 2021, 2022, you went from like $1 on this stock all the way up to 55. So you had a big pump in this one, but then Obviously, eventually, electric vehicle demand started to plateau. We're seeing a flattening out of demand in electric vehicles, and now you've come from 55 all the way back to 10. And I promise you, there's a ton of people that just held all along here. Now, will you get out on the exact top of these things? Absolutely not. There's no reason to try to do that. But as these equipment makers tick up and go vertical like this, there's trailing stops. There's manually moving your stop off. Just move it up, bump it up, bump it up. Understand that you might sell AEHR. Maybe you sold it at 25, 30, and it still went to 50. You got to let that go as an investor. You're never going to get out at the top. Just be happy that you might have bought this one at 2 and you watched it run to 20. That's fantastic. Don't be greedy. Take your profits, because these equipment makers, these equipment suppliers, these component manufacturers, they will have their run and then they will get blasted off into oblivion, because that is what happens in the industry. The big players like Nvidia, ASML, TSM, they'll have ups and down as well. We'll look at the Nvidia chart here in a moment. It goes up and down. It goes up and down, but you can legitimately hold these stocks for the slightly longer term. Just understand that with the smaller component makers, they are going to get absolutely obliterated at some point. But it looks like through 2025 calendar year, things actually look pretty good from a trend perspective, at least during the first half of the year. All this spend will force the component makers to ramp up their supplies. It'll ramp up their sales, and then it'll really be a discussion as we move into the spring and summertime. Is this going to carry over into 2026? That is the thing that I will be thinking about, not only by myself, but with a team and with other people in the industry. We'll be discussing and kind of dissecting what these companies are doing. We'll be looking at demand as well. Is demand still outstripping those types of things? Well, if it is, then 2026 looks particularly good. Obviously, I'll be sharing this all with you here on the program. It is still way too early to figure these things out. We still are just getting going in 2025. Moving over to ARM Holdings. Company reported their earnings this week. During the week, it started at about $152. This one actually reacted nicely to earnings, up about 6%. Year to date on this one, you're up 31% on ARM Holdings. We'll look at it technically after we roll through the Q3 earnings, which came in at $983 million. This one's got a $171 billion market cap. So you are rich on this one. 20% growth rate year over year. As you start to look out into the upcoming quarters as well, it's lumpy with ARM. Some quarters you get a lot of revenue come in through these licenses, and sometimes it falls off a little bit, but you've got really strong growth for several quarters outgoing. Now, they gave us guidance for Q4. It was right on the money. So it was right with expectations, which is interesting. This company actually hasn't been public for very long, but based on their business model where they have a licensing and they kind of bump the licensing fee up every few years. If you're not familiar with ARM Holdings, they basically license a chip design architecture, very similar to how Intel controls the x86. AMD essentially has kind of a license to that as well. So x86 runs in a lot of PCs. It runs in data center. ARM has found a different architecture. It runs a little cooler. It runs a little more efficiently. So it obviously has huge use cases in cell phones, which need to have better battery life and need to run thermally a little cooler than maybe a data center is allowed to do. But what they have found is these things work great in laptops. I have a laptop with an ARM processor in it. It's absolutely fantastic. Qualcomm, which we'll talk about in a minute, has developed several processors using ARM infrastructure, and it's absolutely fantastic. So they've got their hands in a lot of different things. It's primarily still smartphones, which obviously has kind of seen demand plateau, but they're getting their way into other designs as well. It's basically an alternative to the x86 architecture. And you're seeing steady growth rates from a revenue perspective. Like I said, Q4 was basically right on the mark in terms of expectations. Some people might even assume that it was just slightly underneath the expectations, depending on where they come in on that dollar amount. The company also has massive gross profits, okay? And this is what has investors excited. This is why you have a $170 billion market cap on this one. This is why you've got 101 forward PE. It's not the only reason, but it is one of the reasons. We'll talk about how SoftBank owns a big chunk of this and how you could have some opportunities with this one coming up. But one of the reasons why you've got just a big multiple on this one is the fact that you've got massive gross profits, okay? Look at this. Off of $983 million worth of revenue, $955 million of it was gross profit. I mean, this is even better than like a software business because they're basically just selling a design and they're just licensing this. And so they're like selling, I don't want to say they're selling air, but that's kind of what they sell over at ARM. It's really just they're selling a patent. Access to a patent is really what they're selling. So you got these huge gross margins, but the company continues to spend on R&D. They spent $533, up from $432 the previous quarter. Selling, general, administrative. Also, this thing's not really selling itself. $216 up to $247. So your total operating expenses came in at $780. So you take $955, you minus off $780 million, you get to operating income at $175 million. Okay, and that's in a quarter. For 9 months, you made $420 million. Now, you and me, $420 million, yeah, we're crushing it, right? But this is ARM Holdings, which has a $171 billion market cap. So clearly, we've got a long ways to grow into this market cap. Now, ARM Holdings is still 90% owned by SoftBank. And SoftBank has been very active over the past couple of weeks. They had that big announcement with Oracle founder Larry Ellison, also Sam Altman. This was in the White House. They announced, I think it was called Project Stargate. It was big data center spending here in the United States, and big numbers were thrown out. I mean, I saw 50 billion, 100 billion, 500 billion. I mean, it was kind of ridiculous numbers. I think they channeled their inner Trump and they just threw out numbers out there. We'll see what they end up spending. But the point is that SoftBank, in order to meet those targets, and I also saw a press release earlier this week that SoftBank, which again owns, I think they still own about 80 to 90% of the outstanding shares of ARM. And so they agreed, I think, in principle, to make a large investment in OpenAI. And I think one way they're going to fund some of this stuff that they're going to do is they're actually going to sell shares of ARM. So that could create some pressure on the stock. I think you are in this uptrend and you're basically kind of in the middle of the uptrend as it relates to ARM Holdings. You could buy this one if you want to. Again, you're ignoring some of the traditional valuation metrics. You're ignoring the fact that this company is still like years away, years like plural with an S, away from being anywhere close to a reasonable valuation. But here you are with ARM Holdings. Again, I'm just looking at this technically. Technically, this is like kind of a buy. It's not like a screaming buy. You'd be closer to kind of your 200-day moving average down here. Certainly you were there back in December. That is because you'd like to confirm a new higher high up over this set of highs back here in July. That would take you back up over $200 per share. Again, if SoftBank comes in with a sale on this one because they own such a large chunk, and depending on how much they want to spit out into the marketplace, that could create an overhead. Because I think only about 10% of the float is actually even being traded of this company, as more and more percentage of this company gets out into the marketplace. Could create some downward pressure. Get downward pressure, it will make the valuation seem a little bit more reasonable. Could create some buying opportunities. Now, moving over to Qualcomm. These two companies have kind of quabbled, if you will, over their license. We'll talk about that in a minute. But Qualcomm reported their earnings this week. Shares were roughly flat year to date. You're up about 10% on this one. And over the past year, you're up 15%. A little bit of a different company here, almost complete opposite of ARM Holdings. This one's got a tiny multiple, trading at just 14 times forward, $185 billion. Some of the reasons why Qualcomm trades at a slightly lower valuation is the fact that this company relies a lot also on handset and cell phones. And this company has a big deal with Apple, which is set to expire in 2026. In fact, this company is not assuming that deal is going to renew. And so that business is going to go away. So the company is trying to beef up some of its other business units, including automobiles, where they're inside the infotainment systems and the different types of electronics that are going into cars. They also have computer chips that they're working on, but also Internet of Things, things like smart glasses, VR headsets, watches, all those types of things. Qualcomm's got some really nice processors. I tell you what, if I had to buy a PC, a Windows-based PC, I probably would buy one with a Qualcomm chip in it, only because from a performance perspective, I've seen that those have done relatively well compared to Apple's chips, which are almost somewhat of a similar design. Now, revenue in the most recent quarter came in at $11.7 billion. That's still really strong growth. I tell you what, you got a company trading at 14 times forward, growing in the most recent quarter at 17.6%. This is still a really, really strong business. Now, it was a good quarter. You start to look out for this company. The growth rate is starting to slow. So the bar, though, and the way you could look at that as an investor, the bar is going to get lower, okay? Again, as that Apple contract starts to kind of tail off. In fact, the company talked about that on their conference call. I think it was by 2026. I think they're only going to get a percentage of Apple's business as Apple is designing them out of their modem business. But you still have Samsung. You still have Chinese makers, which are gaining market share against Apple in the Chinese market. I don't think any of them are going to design Qualcomm out. That's not really their business model, I don't think, at least in the shorter term. And so Qualcomm's still going to have a great handset business. And what they're telling investors is the automotive business is going to be very good. And obviously Internet of Things is going to expand rapidly. Now, ARM and Qualcomm had a little bit of a squabble. They went to court over this. ARM was trying to withdraw a license that they give to Qualcomm, which would be devastating for Qualcomm, as I believe the Snapdragon chips rely almost exclusively on ARM's licenses. Well, they went to court, and I think Qualcomm was found successful there, and so ARM is not withdrawing that license anytime soon. From a financial perspective, this one's actually pretty good. $11.7 billion, total operating expenses coming in about $8 billion, $3.6 billion of operating income, $3.2 billion of net income. Last year, you're at $2.7 billion. From a balance sheet perspective, you do have plenty of cash over on this company's balance sheet. You do have some inventory as well, although it's not over elevated above the September levels. Got some long-term debt over here, $13 billion, about 1.3 sitting on the short-term side. But that's balanced off by cash over here at Qualcomm. Very financially healthy company. Look at the statement of cash flows. I mean, it was a great quarter. $3 billion of operating cash flow last year. Boom, all the way up to $4.6 billion. They're not spending a bunch on capital expenditures. So what do? They're buying back the stock at levels that make a little bit of sense, okay? Shares haven't just taken off like Nvidia or some of these other companies. So things actually look pretty good financially. You're also getting a dividend over at Qualcomm as well, 2%. Now, would I make Qualcomm my number one holding in my chip portfolio? Absolutely not. But this, based on its valuation, based on its trends, also, if you read through the conference call, management is just not sitting back on its laurels and just kind of cashing in on its handset licenses and those types of things. They're continuing to try to innovate over here. So you do get a little bit of upside on innovation, and you do get the steadiness of the company's business. We might as well look at Qualcomm from a technical perspective as well. This one's kind of locked also in kind of a longer term uptrend that you can see here. This one's a little flatter, so we don't have that like parabolic that we have with the other chip makers. This one's looking good. It's over and above an area where I would be excited about this one, but further pullbacks in Qualcomm, particularly back under 150 on this one, will look particularly exciting. Now, jumping into the rest of the technical segment, we've got the SOXX. This one has just gone sideways. So if you like trades, there is a trade here because you have a clear area of support here. Clearly, people are stepping in at this level down here at about 210 on this one. And I've stepped in at 210 on this one probably 10 times. This is a weekly chart. If you stretch this out to a daily chart, I just do this. You don't have to do this. Don't copy what I do, but I'm comfortable with doing this. I also can tell from some of the comments and the messages I receive, some of you are not comfortable taking a loss on a stock. Like, you have to be able to do that. You have to be able to sell a stock at a loss. In fact, If you are not selling stocks at a loss, you are not ready to trade, because the best traders will snap sell a stock when it gets to a loss. In fact, if you are a good trader, a percentage of your trades are actually going to be at a loss. There's kind of this myth from people that either don't trade or that maybe follow these gurus that only show their winners or whatever, that you're supposed to be a winner 100% of the time, 80% of the time. No, if you set your trades up right, you can actually be a loser, meaning you can get the trade wrong about 40% of the time or so. If you set this thing up right, you only have to be right just over 50% of the time. It's very much like sports betting. I hate comparing the two, stock market to sports betting. I have nothing against sports betting. I used to have a website that was big in daily fantasy sports. In fact, it was one of the largest daily fantasy sports sites in the world at the time. This was years ago when the industry was still at its infancy. So I got no problem with gambling. I don't like to compare them, but the best gamblers, the best sports bettors win only 55, 60% of the time. Same thing with the best traders I know win like 65% of the time. Okay. So be long-winded way to say that you are going to have some losers and you've got to be able to sell it. I literally get messages from people. Hey, the stock broke support. What should I do? And it's like, you had to have sold it. Like, don't message me. Hey, it broke the stop loss. What did I do? You did something wrong. You've got to sell these things. So with the SOXX ETF, with that long caveat in place, this will be better for like the newsletter and the paid product. I'll be able to explain this type of stuff. We'll also weed out the people that don't follow the rules and don't follow proper investing thing. We're just going to kick them out because we don't have time to deal with people where we tell them the stop loss gets broken, and then they message us what they should do. We like literally do not have time for people like that. The stop loss is here at, 210-ish. You can wait for a retest of 210. Put your stop loss just underneath that, 50, 60 cents. You'll find out that day if you are going to make money or not. And as this thing rides up, you're just scalping this. And this is what people are doing, I think, with this. They're just scalping it for profit. I'm scalping this thing 1 or 2%. Boop, 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 boop. That is because I have a portfolio of Nvidia and other chip makers. I'm long those positions because I understand that the back half of the year is probably going to be good. But because I'm following this industry as closely as anybody, I might as well make money in the intermediate in the short term as well. And I think if you're watching a video like this, again, if you understand how trading works and that you are going to be unsuccessful a decent percent of the time, as long as you set your trades up right, money management, never putting more into this trade than you really should, and taking profits when they're there, selling at a short loss, you're going to make money huge percentage of the time. That's the SOXX. The SMH is in a slightly different position, although it is flagging. Okay, this one also has gone sideways. I mean, we're at the same levels with this one as we were in September. So we've been sitting at the same levels, up or down, in the semiconductor industry, really, for the past 4 or 5 months now. So these things have gone nowhere. So when you coil like this, what the market is telling you is we're not really sure. And like I said, if you get on social media, you will see people not sure about this spending. DeepSeek came out and it had people not sure about what things were doing. If you have your head screwed on straight, you believe everything that these companies are doing, you understand even a little bit deeper that their demand is outstripping capacity. If you want to think another layer deeper as well, you understand is AI applications, whether it's email, whether it's essay writing, whether it's getting this on the desk of classrooms, which I saw here. This is just a kind of a side tangent, but the CSU, the California State University system, fully went all in on AI. They're going to they're going to allow faculty and students to use AI in the classroom. This is tens of thousands. In fact, this is probably over 100,000 students here in California, and this will be the trend over the next year or two. You're going to see a tap out of the educational industry. They are going to realize that it's no use getting kids to sit there and type out essays on their own. They're going to give them different ways to present their knowledge, and they're going to allow them to use AI. All of a sudden, you have students using AI. Eventually, your grandma and your mom is going to use AI as well, and that'll be the big moment. I think we still have one more push higher at the very least with a lot of these stocks. including Nvidia. Talked about, I think on last week's show, we described a trade like down here at these levels. If you got in on that one, I mean, you went from 119 to 129. I think you still have a shot, whether it's a shorter term or intermediate term, making a new higher high back into the 160s on this one as you move into earnings, because I don't know how many people have the steel cojones, if you will. And for those of you that are not from America or not from Mexico, wherever cojones originates from, we have a lot of international viewers. It basically means if you don't have the guts, if you don't have the courage to go short Nvidia into earnings, which are just a couple of weeks away. And I can imagine that's the vast majority of traders. Why would you want to short this one into earnings? There'll be some people that decide to do that. I don't have that. I would not have that courage. I don't care what the headlines are. I would not have the courage to short a company like this. So in that scenario, you have existing shorts start to cover. You have people, particularly retail, saying, well, we could buy Nvidia into earnings. It's popped in the past. Really kind of first grade kindergarten type analysis. Some people might bid this up. A little more advanced analysis is you can take all of this CapEx spend and then discuss what we've talked about, in that Nvidia's current quarter probably won't be great. It'll be about at expectations, but Jensen Huang is great about talking about the future, and he would not be scared, at least based on these commitments and the commitments that he's seen, to start talking up the back half of the year. And that will be the key with Nvidia. If they can talk up the back half of the year, then the shares could continue to meaningfully rise. But as we move into earnings, just 2 or 3 weeks away with this company, I could see us walking back up here, back into the 150 range, because again, nobody wants to be on the other side of Nvidia reporting kind of blowout, not necessarily a blowout quarter. I don't think we have a blowout quarter in us with Nvidia, but we could have potentially not necessarily blowout guidance for for Nvidia is a Q1, but I think they could have commentary on the conference call that says, oh my gosh, the spring, summer, fall, winter for us is looking absolutely fantastic. Because if you do the math, that's where the sales are going to show up for Nvidia. Guys, that was the Semiconductor Show. Well, one more. Well, little false start there. We'll look at one more because I know a lot of people are into AMD. This one's dropped. I've had some people say, oh, you recommended AMD and it's down. It's down about 10%. Again, if you can't stomach a stock going down 10%, especially if you start paying us, we are going to give you your money back and say, we are not for you. I cannot deal with people that can't watch a stock go down 10%. In fact, if you liked it 10% higher, you should like it a lot more 10% lower, and you should be buying more of this. And this is what I've been buying. You have an area of support here as you approach $95 with AMD. It's not like the firmest thing. The other thing that if you want to do, you can snap on an indicator, these fixed range volume profiles with AMD. You can snap these on if you want, and you can see here, you're approaching an area where in the past, and this is really over the past 4 or 5 years, this is where the buyers have been with AMD. So the likelihood of AMD finding footing. Now, it doesn't mean it's going to sit here at 107 and then boom, snap back to 202. I mean, that's almost impossible for this company. In fact, I would not project that. But you find the footing and you consolidate and you chop here and then you make your next move higher. That is far more probable. And that is what you're buying here. But when you make long-term investments, guys, you do buy them occasionally and they continue to go down. I am very simple, man. I have green boxes on my charts. When the stock hits the green box, I start buying. Now, if I have $1,000 in my Robinhood account, do I buy all $1,000 of AMD stock when it hits the top of the box? No, I'm not an idiot. I might do $10, $25. Okay, this is an $1,000 account. If you have a $10,000 account, you might buy 500 at this level. If you have a $100,000 account, you might buy 1,000 at this level. And as it continues to walk back, you inch in more and more and more. That is what's called dollar cost averaging. I'm just giving it to you from a visual perspective. Hopefully you guys enjoyed today's video. That was the Semiconductor Show for Sunday, February 9th. I'm sure most of you will be watching the Super Bowl today. So we'll see what happens there if your team's in it. I wish them the best of luck. I'll be watching it just from a fan perspective, and we'll see what happens going into next week. We've got a big week of earnings still, another 2 weeks of solid earnings. We'll see how that impacts the semiconductor market. And then obviously we get Nvidia earnings as well. Hopefully you guys enjoyed today's video. We'll be back again next week. Good luck with your investments.